Hey guys, welcome to the live stream. It is July 7th and the market has closed. We are at 6:35 p.m. in the evening on Monday. And this is the beginning of the week. I think this week's going to be a little bit of a gap week. We have earnings beginning at the end of this week and really getting going next week. So there's a lot of attention on what's going to come out of those earnings. We have President Trump really beginning to use tariffs as kind of an instrument to get negotiations underway with other countries with regards to trade, and that's creating some some concerns out there in the market. Now, it's a little bit of medicine for the markets, in my opinion, because we've been in a real go-go environment with stocks really going up over the last couple months. And investors that really bought the dip a couple months ago are really happy they did so because we're up 25% on the S&P over the course of just a couple months. That was a really good move for whoever did that. And over the last 5 years, the S&P has done great. So what's there not to like about the market? It is expensive. It is an expensive market. So if we have a couple of stories that are creating a sell-off, maybe that's a good thing. Kind of get some of these prices to come down a little bit. When we look at the stocks today, some stocks got hit a little harder than others. Tesla was down 6.79%. Google is down 1.5%. Berkshire's down quite a bit. Ever since Warren Buffett said he was going to turn control of Berkshire Hathaway over to his successor, that stock has not done well. And that's usually kind of a safety stock. A lot of investors go there. And for decades, they went there because Warren Buffett was at the helm. And now that I think it's beginning to be realized, I guess, that, hey, Warren Buffett's not going to live forever. And he just turned over control of Berkshire Hathaway over to his successor. I think that's having a lot to do with Berkshire Hathaway's underperforming other big cap stocks. Apple was down, but what's new in 2025? Apple is not doing well. In semiconductor, the space was down. Qualcomm was down substantially. AMD was down. Intel was down. Um, in healthcare, we had some stocks that were down. United Healthcare was down. So I think it was a pretty good sell-off day. Now, when you have an expensive market, not a big surprise that you can have investors be quick to sell off their positions. Hey, take the gain, take that gain already. So not a big surprise. Looks like we've got a couple people in the stream. Sebastian, good to see you. And thanks again for the suggestion last week. I think you suggested XP, and I really liked that company. I did a lot of analysis, and I created a member-only video. Maybe you saw it. So thanks for that tip. Keep them coming. It looks like STC Picks. Good to see you. Thanks everybody for tuning in. Looks like we're growing the streaming people or the number of people on the stream. So thanks for joining. So what are we going to do with this market? It's expensive. We've got the market's being a little bit greedy. We're not in extreme greed, but we're in the greed zone. And how you doing, Mike? Yeah, thanks for the good regards there. And let's see how this market trades, Mike. We might see a nice little pullback and it creates better pricing, but we'll see. We'll see what the market does. So yeah, so we got extreme greed going on. You know, it's if you own the stocks, then your portfolio's up. Nothing wrong with that. There's nothing wrong with that at all. But it is rational to see the market sell off a bit and give up just a little bit of those gains. The futures are going to open up a little lower according to what we're seeing right now, because I think the whole tariff story is still upon us. It's not going anywhere. So we'll see. We'll see where it goes. As mentioned, we've got earnings, and I'm going to say they're going to kind of begin on Thursday. We have Delta Airlines and Conagra Brands, Levi Strauss, Vista Energy announcing. Vista is an energy company, so I'm sure that's got some eyeballs on it. And then after that, the 11th, we've got not a lot of big names, but it's next week when we start seeing some bigger names. The banks come out next week on July 17th, and their earnings will be, I'm expecting they're going to have good earnings because banks have been operating with the expectation that the economy was going to do poorly, but the economy's held up. So I think there's going to be good profits reported by all these big banks, and the stocks have been rallying, over the last couple of weeks. They've been going up nicely. So we'll see what they report. But really, it's going to get hot and heavy and stay hot and heavy for a while. So we'll be real busy keeping up with all the earnings. Looks like Mohammed is joined the stream. Good to see you. STC Picks. Has anyone looked at BBWI yet? Yeah, I'm not familiar with that stock, but if you'd like me to look at it, $5 super chat or join the channel and then I can look at stocks like that. Two options to go with there. Speaking of which, looks like Mike's got a comment. Let me cover Mike's comment and then we're going to get into some stocks. Tariffs are supposedly been extended to August 1st. Okay, yeah, we'll see. And I think, the tariffs, it was certainly caught the market's attention. Geez, caught the whole business world's attention back in April. And I think if we can deal with that, we can probably deal with like some tension around tariffs. That's just my observation. I'm not investing based on what these tariffs are going to result in. Are they going to be negotiated quickly? Is the U.S. going to get the upper hand, or is another country going to get the upper hand? Those pieces there, I'm not quite sure how that's going to get resolved. But I can tell you, I'd rather just buy great businesses that are going to be worth a lot more money in the future, make good decisions on my buying of shares in those great businesses, and then hold them. Hold them for as long as it makes sense. Just to explain my methodology, my strategy in investing, I'm an active value investor with a preference to get into companies that really own the future. They own future technology markets. They own current technology markets, but they really do have strong moats that will keep them on top, and they will be able to deliver very good profits and free cash flow to investors. That's what I'm looking for out of companies. The easiest ones to find are the big ones, right? Because it's obvious that a lot of investors believe in Microsoft, Amazon, Meta, Nvidia. Those are kind of the easy ones to find, and picking the right ones is important. But the ones that are really satisfying is when you find one of those smaller caps and it really takes off, or maybe you find a couple and they take off for you. Those can really grow your wealth fast, and those are the ones that I try to find. So as we look at stocks today, you'll see my methodology in action. I'll be analyzing companies, looking at their free cash flows, profitability, and trying to get to what is the intrinsic value of that business? Is it a very desirable business? Am I willing to pay a fair price for that stock? Or, it's not a super desirable company, so I'd really need to get a really nice discount in order for me to be an investor. So we'll go through that together. I'll show you a couple of examples. And these are going to be examples of paid members of the channel have emailed me or got on the Discord and suggested a few stocks, and that's what we're going to cover. We're going to start with Zeta, and Zeta Global Holdings Corporation is a company that operates an omni-channel data-driven cloud platform that provides enterprises with consumer intelligence marketing automation software in the US and internationally. These guys remind me of AppLovin. If you're familiar with AppLovin, This is what this company reminds me of. This was a member request, so I'm going to go through it and take a look at it. I believe it was Bobby that suggested this one. The market cap of Zeta is 3.5 billion. Revenue is 1.08 billion. So not too expensive if you look at price to sales. Forward P looks good, 21. The current year they don't have a P. It looks like they're losing money. Analysts think this one's wildly discounted, 92% discount. Year to date, it's down 17%. Over the 1 year, it's down 14%. Let's take a look. Is this thing an opportunity, or is the market, am I agreeing with what the market's doing to the stock price? So here's their website. Of course, a lot of companies put AI in their description now. Everything's AI. So not to take anything away from them, but it's kind of a marketing exercise these days to put AI into your description. So these guys are used by a lot of companies to do their marketing. All right, that looks good. And when we look at their profile, these guys are located in New York. Okay. Let's take a look at their growth, profitability, and so forth. I glanced at this before the stream started, and I'll pick out the things that I like and the things that I don't like. All right, so starting with the things I like. Growth is good, 40% on $1 billion. That's really good. That's really good growth. Now, what I found surprising about this stock is the gross margins are a little bit low, 60%. If they're a pure play software company, especially an AI software company, the margins should be better, right? What are you paying for if you're paying, if you're basically paying 40% of your product cost. This is your revenue. The cost of that revenue, that's what it costs you to create the product that is going to be available to the customer. Software companies typically have a very low cost of revenue, very low cost of that incremental customer using the software. It's almost like cost of nothing. That's why the margins are so high. So there's something there that tells me, well, this may not be a pure play software company. These guys may provide a lot of services, which is not as good as software. When you sell software, it's super profitable. Microsoft's a software company, and there are others that have just made fortunes because they're so profitable. And they make great software. So these guys have a lower margin than I would like. Not a terrible margin. 60% is pretty good. Their free cash flow margin's okay, 11%. Now, if I look at this stock and say, here's my free cash flow from the trailing 12 months, and they do have a pretty good growth rate. I'm going to multiply that times 30 minus debt. So I get to about $3.6 billion of value for this business. And let's take a look at what their debt's all about. So when we look at their debt, they've got an excess cash position of 156 million. So they're actually worth about $3.7 billion in value, just high level. So right now their market cap's 3.5 billion. So I think they're fairly priced. There's no incredible discount available to me. And their growth rate's good, but they're small. It's not like, Microsoft is growing at 20% and they're gigantic. That's incredible. When $1 billion business is growing at 40%, that is good. But man, I got to be presented a better discount than that. The market's not excited about this stock. One of the things about, software companies, especially, is some of these are just getting completely ignored. There's some stories out there that may be the reason why these software companies are not getting much attention and investment from investors. Their expectation that AI is going to basically write software, make it super affordable and accessible. And I think there'll be some examples of that, but I've worked in software for a long time, by the way, and there's just a lot there for human beings to have to figure out. And there's a lot there for human beings to be involved in the creation of very good software. So I think that thought is a little exaggerated. Can AI potentially create a spreadsheet for you? Absolutely. Can it render like some images? Yeah. Can you have a conversation with AI? Absolutely. But for it to create software, I wouldn't go that far. And Zeta, the market's not liking it. It's kind of selling it off. I think it's fairly priced. In order for me to be an investor in a company like this, you'd have to present a really compelling discount to the point where I'm like, hey, this 50% discounted. If I buy this, I could potentially make a very, very good windfall. And that's not the case with Zeta. It's just priced fairly. So this one here would be a pass for me. I wouldn't invest a whole lot more time. There's other stocks that resemble this, AppLovin being one of them, and another company that's a little smaller is DSP, DSP and AppLovin. DSP is similar to Zeta, and I think they have really good fundamentals. This stock is doing poorly for the year to date. It's really sold off. For the 1 year, look at this chart. It went sky high and then it came back down to earth. Isn't that incredible? And looks like somebody has a comment on AppLovin, has too much debt. Well, take a look at that. I'm glad you're looking at the balance sheet. Nicely done. But this stock here, it's really had a roller coaster ride. And they are about the same size of Zeta. They're a little smaller, They have a profit this year. They have about the same forward PE as Zeta, and their growth is 30%. Now they're growing at 30%, and I thought they were bigger than that in the previous screen. Let's take a look. So they are 300 market cap. Yeah, so they're 1/3 the size of Zeta. I take that back. I misspoke. The market cap is 858 million. So this is a really small cap company. Now the thing that I like about this is growth is good, but they're tiny, right? They're a tiny company. Now when we look at these margins, 45%. So these are not awesome world-class margins, by the way. But this is an idea. This is a company in the space. They also do marketing software and help businesses spend their marketing dollars. Nowadays, marketers are spending their marketing dollars on streaming platforms like YouTube, like Netflix, Amazon Prime, and optimizing that. They're also spending that advertising dollar on social media platforms like Facebook, Instagram, Reddit, and TikTok. So that's what the software is doing for businesses. So you have a couple competitors in the space. Let's take a look at AppLovin, which is probably, in my mind, the most recognized company in the space. This stock has had kind of a wild ride. It really shot up in 2024. Look at that, it got up to $510 per share. Wow, incredible. Year to date, up 6%, and you've had a wild ride. Boy, you got your money's worth. If you're looking for thrills and excitement, you got it. You're close to back to even. So that's been a wild ride. That's year to date. Of course, the big sell off in all stocks really impacted smaller caps much more than other stocks. And AppLovin was dealing with one of the famous or more recognized short sellers came out with a story that said that AppLovin's violating the privacy agreements. Like you're not supposed to use people's private data to do marketing. And AppLovin circumvents the rules and kind of does it the way that they do it. Of course, they would deny it. And the short seller would say, no, they're actually doing it. I don't know who's right, but the story was out there. That's what affected the stock price quite a bit. You see this spike here. This means that investors really liked AppLovin. It's a big cap. I mean, that's way bigger than Zeta or DSP, $116 billion in market cap. It's just gone up so darn fast. and revenue is 5 billion. So you're paying like 23, 24 times revenue, which is pretty expensive stock. We'll see how they're growing. PE, they are profitable. Forward PE is also positive. Analysts think they're discounted by about 19%. They are growing really well, 41% on a big number of 5 billion. That is excellent growth. Excellent growth. Now we're going to look at that balance sheet because one of the viewers of the stream tipped me that, hey, they may have too much debt. So we're going to take a peek at that. So let's take a look at margins of AppLovin. Let's look at free cash flow that they generate. So look at these beautiful margins. Oh man, that's like, see as they get bigger, see how the margins are getting bigger? Totally makes sense, right? You only have to build the corporate headquarters once. You only have to hire one HR team. You only have to hire, certain developers. You're not having to hire developers over time as much. Once your platform is stable, you're pretty much, you have your engineers and developers maintaining the platform, and it gets far more profitable. They're up to 77.7%, and as they get even bigger, that number is going to go up even higher. I'm very attracted to high margin businesses, by the way. Free cash flow margin 49%. Holy smokes, that's beautiful. That's awesome. Is that legal? Of course it is. This is free enterprise capitalism, but that looks really, really good. So I'm really impressed with those numbers. But let's take a look at that balance sheet. Make sure that, hey, show me your balance sheet. I don't want you going bankrupt on me. Well, let's take a look. Debt is $3.7 billion. They do have some cash, so they do have some debt there. 3.7. Now I measure, is that a lot of debt or a little debt, by debt to EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. And what this represents, just high level, theoretically, is a company's ability to pay off debt. If they really just focused at EBITDA toward paying off debt, 1.3 is not a troubled company. Under 3 is a well capitalized company. It's not in trouble. If you see a company with like a 6 or a 7, that company's in trouble. That's way too much debt. But I would have to say that the debt level is not a concern for me, not a concern at all. I think that they may have needed some debt to grow, and they're getting it done. So is AppLovin discounted? Well, I think I'd done a valuation of AppLovin. So let's just jump to my valuation on AppLovin, and I can show you what I think about this stock. I think AppLovin's a really interesting stock. Let's see if I can find the right one. That's Apple. No, we don't want to talk about Apple. We want to talk about AppLovin. I think it's nearly fairly priced, and their fundamentals are excellent, but the stock just went up so much in 2024 that it is a little bit of a risky stock. And I guess I'm not the only one that believes that, because when you look at where the stock's been, holy smokes, man, you were like, you go to Six Flags Magic Mountain and you get on the scariest roller coaster. That's what AppLovin's all about, because you went way up. I mean, you were feeling like a genius last year. You were a genius if you bought AppLovin August 5th. It went up 659%. And you're like, wow, that is awesome. But then the stock just plummeted from there. It just went down. It was like skydiving. It went down 57%. Wow, that went down. Since it hit that low, you look like a genius again. You're up 57. So this one here, I mean, this one's going to be exciting. It's going to be wild, and I need a discount. I think that a wild stock like this could come down to earth a little more, especially if we have a really solid sell-off. That's what I'd be waiting to get into AppLovin. I think it is a good business, by the way. I think it's a terrific business, and they're showing that they have the best margins. I just showed you 3 companies that are similar, and these guys have the best margins. So I like that a lot. So that is Zeta. And as a bonus, we looked at 2 companies that are like Zeta. Zeta's a pass. DSP is investable, but I'm not in the stock. I don't think it's good enough. And AppLovin, I think, is too risky for the discount I'm getting. And I'm not getting a discount, so I'm not going to invest in AppLovin. I'd rather keep my investments in other stocks that are doing great. So let's move on to the next one. The next one is EPAM. And before I do that, let me take a look at the comments, just to say hello to some people. So STC Picks, thanks again for joining. Sounds good. Neil Weston, what's up, man? You've been a long time attendee. I appreciate you joining. I'm not sure what your comment means, but maybe others do. So JVM, thanks for joining, man. Thanks for the comment on the balance sheet. And then Magical Self. So Shark Ninja, huh? The only thing I'd say about Shark Ninja is I've bought some of their products. The quality level isn't great. They tend to break. They tend to not last a long time, which is kind of a pain, right? I like buying products that last a while. That's just been my experience. I don't know if you guys have had the similar experience, but I had a blender and it worked well for literally like 3 months, and then it didn't. And I bought a different brand, and that one has pretty much lasted up until this point. And that experience was like 3-4 years ago. So Shark Ninja is like a marketing company that makes products based on what their marketing research tells them. They kind of copy other products and make them. They're probably really successful, but if you become a member, I'd be happy to look at it. Or if you buy a $5 super chat, I could take a look at the fundamentals. What do I think about Tesla right now? I just can't invest in Tesla because it's not an investment based on fundamentals. It's like, you know, what's Elon Musk going to do this week? And is he going to be arguing with the president of the US? It's just, are you going to believe in the dreams that he's spinning? Like, oh, we're going to be the biggest robo-taxi company in the world. Well, maybe they are, but just show me some evidence of that first. They put 20 cars in a test run in Austin, Texas, which is a nice little test, and all 20 were all Tesla friendly reviewers. That's not putting it, a real, robo taxi service out there. Waymo has a real robo taxi service out there, and the Chinese have real robo taxi services out there. Tesla doesn't, so I don't really think Tesla's an investment for me. Golden, thoughts on Nubank? I hold Nubank. I'd give you that much, and I think it's an interesting stock. It's down in South America, so I think it's an interesting stock that I'm going to continue to hold. But my best holding in that space is Robinhood. It's just been the number one percentage performer in my portfolio, and I'm glad I own it. All right, the next stock we're going to take a look at is, again, another paid member request, EPAM. And EPAM is a company. They do digital platform engineering, software development, and they offer engineering services. And I think they do services to help you build systems, integrate, and implement systems. So they're more of a services company. $10 billion market cap. Revenue is 4.86, so you're paying a little over 2 times sales. PE is 25 for the current year and 16 for the next year. Analysts think it's discounted. Now, there is a distinction when you go information technology. This is services. It's not as good as software. They're not as profitable, and it's not as lucrative. When you look at their gross margins, see these margins 30%. We just saw AppLovin at 77. That's a pure play software company. Much more profitable. So I want AppLovin. I don't want services businesses unless I'm going to get a wild discount. So this one here, just out of the gate, not as desirable. Generates, $418 million free cash flow looking at the trailing 12 months. maybe we multiply that, if they don't have any debt by 20, we get to like 8-9 billion. We're still short of the market cap. So this one here is not investable for me. Look at the balance sheet. They have more cash than debt, well over um, the debt level. They have $1 billion of net cash. So this one's probably fairly priced, and that's not the investment I'm looking for. The market's really sold it off and doesn't have a lot of momentum. So this one here, just services business, no thank you. I'm looking for the next lightning in the bottle. I'm looking for the next, Microsoft, Uber. Uber is a fantastic investment. I think it's going to go higher, but I'm looking for the next one that looks like that. And EPAM is not qualifying for that particular position. So EPAM is a pass. So I know the same person, Bobby, asked about Zeta and EPAM, and those are my opinions on both. I had looked at those. It's been a while, but I think I came to the same conclusion on both. And remember that in the market, we get choices. We get to choose. There's no rule that I have to buy a stock. I could buy the stocks that I think are the best, the companies that I think are the best, and then be selective of when I'm going to buy them. Buy them at a discount, because I've shown you charts where stocks go up and down. Well, buy them when they're down, right? Make sure you find good businesses, and then you kind of just follow them, and then you buy when those shares are nice and low. That is how we make a lot of money. All right, so Adyen is a payment company. They're out of Holland, or I should say the Netherlands, and they're out of Amsterdam. Now these guys are a little bit like PayPal, a little bit like Coinbase, more like PayPal than they are at Coinbase, and they are a pretty good market cap. 57 billion, revenue is 2 billion, so that you are paying a pretty good price for this company, paying like 30 times revenue. Oof. PE is high, and that PE ratio is, or excuse me, price to sales ratio is high because of the revenue growth, almost 24%. They have $2 billion total revenue number, so that's pretty good growth, 23%. Their profitability is good, 65%. Could be better. See, they were more profitable in the past. Looks like maybe competition's entering their market. It's becoming more expensive, and it shouldn't be the case as you get bigger, your margins drop. No, it should be as you get bigger, your margins expand, unless you're diversifying your business or if you're being competed against, right? Competition's coming to the marketplace and making you reduce your price, or if the service you're providing or the experience you're providing requires more people to be involved, you have to pay people to do the service. So this gross margin's not looking perfect, right? AppLovin was a really good example of good margins. The profit margin is very good, and then free cash flow margin 79%. How is that? That is really seems unattainable. So 1.6 billion. So 1.6 billion. If you multiply that times, let's say 30, you'd get to about 48 billion. We're still short of that market cap. These guys are year to date, they're up 24%. Over the 1 year, they're up 47%. That's pretty good. That's pretty darn good. The growth is really attracting investors that want a growth stock. And this one here, so this one's in the Netherlands. Let me take a look at their balance sheet, or actually I could look at it here. Their debt, they have a lot of cash, $10 billion in cash. That's very good. So this stock as well is priced fairly. I mean, if I took that 1.6 billion, multiplied it times 30, I get 48 plus that 10 billion that they have in excess cash, you up to 58 billion. So you're priced right on the button. And that would not be an investment for me because it's out of my home country. I'm taking a higher risk. I'm not getting a discount. So this business may be nice, good, but it's not good enough. I bought Robinhood when I thought it was really discounted, and I bought it at the right time. Robinhood was doubted by many, but I believed in their story. when you look at their stock price, they IPO'd and they were way up there. And then the stock market just said, hey, Robinhood is just a bag of hammers. Just throw it away. 85% discount. And actually, it's higher than that, like 88% discount. So if you believed in Robinhood, as I did, you're just, you're just printing money on this stock, which has been a really, really good stock. And this is the example that, I can show example after example is I believed in this business. I thought it was a terrific business because they don't follow the rules of Wall Street. They don't want to be the next brokerage that kind of does it the way they did it, just a little bit better. No. They're like, no, we don't have a rule book. We're going to create a trading platform that we think our new investor client wants to use. New investor meaning there's a lot of young people investing. It's awesome. I met a 25-year-old today just in the course of my day. And somehow he brought up NVIDIA. We ended up talking about stocks. He's 25. He's been investing for a couple of years, really excited about it. And I told him, you keep at it, you're going to be a millionaire by the time you're 45. You're going to have plenty of money in your lifetime. If you invest your time, you learn, you develop skills to be an investor, you're going to get there. And I think Robinhood knows that now so many retail investors are actively managing their investments. They don't want to give their money to like a Bernie Madoff that's just going to take their money and destroy it, or that's the worst case scenario. But there are a lot of hedge fund managers, or I should say fund managers, ETF managers, and I would say that their talent level is just, mediocre, and they charge fees. Right? Why would you pay that, right? Instead, manage your own money, learn, establish skill sets, and just continue to get more and more uh, able to grow your wealth. That's the essence of it. Robinhood is growing the retail investor community. They're really doing it well. They're communicating with that investor community in the way that they want to invest. They have a platform that really makes sense to that investor. They're in a lot of different markets that make sense, like Bitcoin and so forth. So the story behind Robinhood totally made sense to me, and I was able to get the stock at a really nice discount. That's what I'm looking for. Look for great businesses. I was a longtime JP Morgan investor, so I know what a good financial services company looks like. When I looked at Robinhood, I was really excited about it, so I invested in it, and this is my number one performer from a percentage standpoint at this time. So Adyen is not going to it's not going to make it. Now, why are these stocks not making it? Well, part of it is that, we got this market that has been just going up and up. And as the market really appreciates, prices are expensive. It's really hard to get a good deal on a stock. That's just reality. We need a nice correction. We need a nice, crash. We need a nice recession to break down stock prices. And that's just the reality. Investing when it's the scariest moments is the best investing. And the community that we have where we communicate on Discord, on investor calls, we were talking about this being Christmas. April 8th, when the market's tanking and man, stocks are just getting sold off like they're just absolutely worthless. That was Christmas. That was Santa Claus coming in on his sleigh with a bag full of presents and saying, hey, you can have this great business for a discount. You can have this great business for a discount. And that's what you got to be ready for. So now we got to practice some patience. We got to be a little patient. We can't chase things right now. If you chase things right now, you're going to overpay. And you're going to wake up when we have another correction like this and say, man, why did I deploy all my capital? Should have saved some of it. Because Santa Claus is going to come back into town. And he's going to come back into town. He takes his time, right? He goes from the North Pole down to our chimneys. And in this case here, it took him like 2 months, which is pretty fast. Usually this happens over 6 months. So you got to be patient, study the market, do your homework. Like I told that 25-year-old today, man, you just got to be a student of the game. Just keep learning, keep advancing your skill set, keep just becoming better each month, each year, and you will be unstoppable. You'll wake up and you'll have the ability to really grow your wealth, and hopefully at some point just have that flexibility due to your economic position in life to do things that are interesting to you. Anthony, what's up? Tony, my man Tony, what's going on, buddy? I feel like markets can't move much higher than they are this year without more earnings. Yeah, I so if I use the rational side of my brain, I agree with you. In fact, I would say we could probably go lower, but I'm using the realistic side of my brain, which is the market's got momentum. A lot of people stare at their, you know, statements, or they hear that, you name the stock, Rocket Labs is up 500%, and they just don't want to miss out when they throw money into the market. So I think the market can actually move higher. And if we have earnings come up that are positive, look out, we can go up another 10, 20%. Now, the drop is going to be that much steeper on the downside. But hey, man, this is stock investing. We know that's part of the game. In the last 5 years, look, in 2022, the market said, hey, we're going to rip your face off and take 25% off. The S&P, those are trillions of dollars of value. And just, I mean, it's like in our recent memory, the market went down 20% on the S&P. And the S&P, what's the, let me put AI to work here. What is the market cap of the S&P? And I like kind of putting the magnitude of these moves, right? So the S&P is 55 trillion. So when you have a 20% move, that's $11 trillion of money leaving the market. That's massive. So when you have a move like that, it's humongous, and the market does that, which is super interesting, but it's realistic. So I agree with you, Tony, that if we rationalize, the market's expensive, but I think the momentum is going to take us higher. We'll see. We'll see. That's my best guess. And remember, nobody can predict going forward. Even the great Warren Buffett will tell you. Anybody who tells you they can tell you that the market's going to go up or down is making it up or lying. So good to see you, Tony. JBM. I don't own C Limited. I'm familiar with it, but I don't own it. All right, guys. So I'm going to keep it a little short and sweet this evening. I've got some things to do. It's a busy week for me, but it's been a couple of days. I had a good, nice long weekend with my family and didn't get to stream much or create many videos. I did create a couple for members. And Sebastian, good to see you. You want to check out a couple of companies, FinV and ENVA. All right, let's take a look at those. Let's take a look at those before I conclude. ENVA. All right, let's take a peek. So Finvolution Group. The Finvolution Group, an investment holding company, operates in the online consumer finance industry in China. Okay. All right, so this is a Chinese company. They are 2.5 billion market cap, revenues 1.85, so you're paying 2 times sales. It's a Chinese company, so these fundamentals look terrific. This company was in the US, it'd be priced twice as high. It's just in China, small cap. You're dealing with a lot of discounting. Just it's a reality. Like, Chinese stocks are not going to get valued at the same level as US stocks. So that's just realistic, but let's keep moving on, see what this company's all about. I want to take a peek at their website because I like to kind of just get a sense of what these guys are all about. They're in Shanghai. Let's see if I'm sure they're going to present this in English. Perfect. Okay. All right. So corporate information. So this is FinTech. financial technology like PayPal, like Block. Okay. And these guys are different. They're also supporting like the lending um, industries. So I think they're doing more of that. So all right, good to kind of have a general sense of what they're doing. They're doing financial services, financial technology. Okay, so that's good. 2.5 billion. We went over that. Now their growth is underwhelming. 5.4%, 3.85. And they're not gigantic. In finance, if they're doing lending, and this is in the Chinese yuan, okay? So this is like you multiply this times 0.17, excuse me. And that would be like I'm gonna do it in my head like 2 billion to 2.2 billion, and you're only growing at 5%. So to me, that's underwhelming. That's like, okay, you're not a growth stock, you're just growing single digit, and you're not gigantic. So what's going on? Let's look at the quarterly to see. Now they are looking better in the most recent quarter. What's their stock doing? What kind of performance are they doing? Year to date, 47%. Nice. 105% over the 1 year. Wow, beautiful. This is a tiny cap. Wow, this is an incredible find. But look at that. It's doing really well. Okay, so the growth rate is underwhelming. That is a concern. Now, this is a lender, or actually, they're a fintech, so it's not like a lender. Free cash flow, and again, we're dealing with the Chinese currency. Now, one way you can kind of make it simple is on stock analysis, when you go to statistics, they convert all this stuff to US dollars. So I'm able to go to the free cash flow numbers and see that they're generating $442 million of free cash flow. Looks good, 442. So when we look at their margins, because they are fintech, they're not like a lender. Cash flow looks good. Gross margins, man, 79%. Hello, that looks great. Man, the fundamentals look superb on this company. So 400 million. So this stock's discounted. This is a discounted stock. It's just a small cap. Man, I am a little chicken of buying stocks in China that are small caps. It's not the zone that I like to operate in. But I'm going to value this stock, and then you always make your own decision on investments. But for me, I'm in the U.S. I own a couple of Chinese stocks, Alibaba, and I own Futu, which I've been doing well with. I've been doing well with Alibaba, and I own an ETF in China. This one's probably a little too small, outside my wheelhouse. And fintech has not been a great performer for me. So I'd probably be like not an investor, but let's look at the fundamentals. Let's look at the fundamentals and see what we end up with, because it is looking like this is a fundamentally it's a good investment. So let me open up. I'm going to open up a browser you guys can't see, so I can show the screen where I'm doing the valuation on it, and then you can see how we're creating a valuation from scratch. Now, when you look at the last 100 years of investing, Benjamin Graham, he did discounting free cash flows. And to this day, it's the number one way of establishing the value of a company because it makes sense. Companies represent how much cash they're going to load the balance sheet with. And they can give you dividends, buy back shares. And if they ever got acquired and they gave you money, they give you the money on the balance sheet plus whatever they paid for the stock. So all those things still hold true to this day. Now I'm going to use, this is fintech, but it kind of reminds me of Futu, because Futu is a Hong Kong based company. These guys are in Shanghai. but I think it's close enough. So let's take a look. So I'm going to make some space here so I can insert the model. And this is a model I created. It's Google Sheet. I originally created it on Excel, but then I moved it to Google Sheets. And I'm glad I did so. I think Google Sheets is better. I was running out of like horsepower on Excel, but on Google Sheets, man, this thing is I haven't had any performance issues, and this model is huge, and I've got so much data in my Google Sheet. My computer used to crawl on Microsoft Excel. So if you're an Excel user and you're like, man, I'll never give up Excel. All right, well, try Google Sheets. I think it provides certain advantages, especially if you want to share data with other people. All right, so we're going to go with FinV. And they had that snazzy name. Sure would pass my high school English teacher's test, but that's what they named their company. All right, so I'm going to go with a high discount rate. American companies with good balance sheets, I'd probably go with an 8. But this is a Chinese company. It's a small cap that I've never heard of, so I'm actually going to go to 12. The free cash flow number, I think, was 442. Now, they're growing nicely, right? So what was their growth rate? And I think that's where I was beginning to feel a lack of confidence is look at this growth rate. Why are they slowing down? Now, their most recent quarter was 10%, but I'd still be monitoring it and saying, if you guys stop growing, we're going to have a problem. Your stock's going to drop because if you're not a growth stock, you're not going to be priced like a growth stock. So let's take a look at their free cash flow, see how that's growing. Man, is that expanding? That's expanding nicely over these years. Interesting. Okay. So, and you know where I get the growth rate on cash is when I look at this screen here. It's going to give me the free cash flow margin. And man, they're growing cash flow fast. Okay. All right. So these guys are growing cash flow fast. So I'm going to say they're going to grow cash 25% in those years. This is 442, and I'm going to add, 25% because this first field represents the next 12 months. It's not like, the last 12 months of the year. So that's where we're at. So you see that if they grow at that level, and we'll go with a 4% terminal value growth, you just get a high intrinsic value. I knew we were going to get there because there's just no way around it. When you have $442 million of free cash flow and you have a really low market cap, yeah, this is going to be valued higher. No wonder investors are really, really interested in the stock. And they had more cash than they did debt. So let me take a peek at that. And what was their, so they had $1,170,000,000 in cash. And they had very little debt, $8 million in debt. All right, so that adds to the value because this is the value of the cash that they are going to make in the future. This is the value of the cash on the balance sheet already in hand. And their market cap's really low, but I haven't updated something. Give me a second. I have to update something. And this is 441. I need to update the share count because the share count right now is not correct. So they have 252 million shares outstanding. All right, so now we have the market cap is correct. It's 78% discounted based on cash flow. That cash flow is really strong. Let's take a peek at per share. Now, the company is being evaluated by 2 analysts. Not a lot of data. Now, this is in the yuan again. Okay, so that number is supposed to be $12 times 0.17 218. I'm gonna give them a 12 because they're in China. It's still discounted. Man, this company is discounted big time. So this company here, the fundamentals are there. Okay. You need to make a decision. Do I believe the market's going to want to buy into this company? It's a small fintech company in China. That's what's tough in China. You can find 25 companies that have fabulous fundamentals. And the one thing that I try to just keep an eye on is the market can turn on China and then it gets really brutal. We've seen that before. So I don't want that much exposure to China. Right now, I think it's enough. But who knows? If the market in the US stays really expensive, maybe I will go into FinV. Um, this is, if you believe in China and you believe their economy is going to do well and you think this business is sound, I would watch some videos on this company, really get to know them, try to be impartial about it, where you're like, I don't want to look at the company and try to find reasons to buy into it. No, try to be impartial and kind of go, look, let me look at the bad things about it. Let me look at the positive things about it. Let me try to ascertain my confidence level in the business. The fundamentals are there, absolutely there, and that business is good. So looks good. Nice find. Again, nice work. So I'm gonna make myself a note that I want to come back and fill this one out. What was the name of this? I'm gonna watch this stock. Maybe I'll wake up in a month and say, man, these American stocks are so expensive. I'm going to China. Going to China to find some good value. Maybe I will buy this stock. But for now, I'm going to pump the brakes and slow down a little bit. I'll sleep on it and see how I feel about it tomorrow. But that's the kind of fundamental value we're looking for, right? We saw some stocks early in the stream where they didn't have a lot of value. They're not growing. They don't have a lot of cash flow. Then you find when you're like, holy smokes, this is like we struck gold. We found a company that's really generating a lot of cash, but it's in China. So just be aware when you invest in China, you may not get the result you're looking for just because the market doesn't buy Chinese stocks as much as they do American stocks. So nice work, Sebastian. Tony, XP feels like a winner. Yeah, I've been beginning to buy into that one. Tomas, how are you, sir? How many users does So that's a good question. Ask that question of like Gemini or somehow and find that. That's a very good question. And I would also add to your analysis is what's been their user growth? Like, are they steadily adding more users? That would be a very good metric to look at because that would show a strong business. But if they're kind of idle on users, that might be a problem. Like, hey, wait a second, how come they're not growing users? Saeed, very good to see you. With all the same discount, would you buy Oscar or Reddit? Reddit. So, because I know Reddit, it's my opinion, but I think Reddit's gonna work. That's just like makes way too much sense. I think Oscar's gonna work, but healthcare is, you know, the government's really involved in healthcare. So the government can really get in the way of a really good idea. The government gets in the way of a lot of efficiency. Reddit is just unstoppable. I think it's going to be successful. That's a very good question, by the way. If I had the same discount, which one would you buy? I'd buy Reddit, but I'm currently buying both stocks, by the way. I'd be willing to buy Oscar and Reddit, but Reddit would be my preference. Reddit's been flourishing, and we picked up Reddit this year. It was discounted nicely. Again, pick businesses you want to own, be patient, let the market discount them, buy them, right? Santa Claus is going to come into town, and he had Reddit in his bag. He gave me a nice discount, and now the stock's pretty much trading at fair value. So the opportunity on Reddit existed about 3 months ago, and now it's priced at fair value. But that is the game we're in. All right, we got another stock to go. ENVA. All right, I'm going to keep this one out there because I'm probably going to come back later, take a look at that company again. You know what I like about live streams is, I go about my day investing, doing things, and I like you guys are the idea engine. Like you came up with China, and now I'm beginning to think, well, maybe I got to revisit China because all these American stocks are expensive, man. I just showed a bunch of examples, and maybe so it's cool to do streaming because then you guys generate really cool ideas. Nicely done, nicely done. All right, Innova International. Technology and analytics company provides online financial services in the US, Brazil, internationally. Provides installment loans, line of credit accounts, CSO programs, including loans with independent third-party lenders, assisting in the preparation of loan applications, loan documents. Okay. Financials, credit services. Now, do these guys handle the technology, or are they actually kind of providing the financing? Yeah, so they're saying they're technology and analytics. So they're a little bit like these new fintech companies that are all like buy now, pay later kind of programs that try to use big data, and they go, oh, well, that person is credit worthy and so forth. All right, so that looks interesting. So our businesses, okay, CashNet, CreditNet, OnDeck, okay. All right, so it looks like they have a number of businesses. All right. So these guys, where are they located? They're traded on the New York Stock Exchange. They're in Chicago. Chicago has a big financial center. That's where commodities used to be traded in person. Now computers handle that. But it is a big financial center. Okay, so we've got a $3 billion market cap, $1.3 billion in revenue. The PE looks really low. Forward PE looks really low. Analysts think it's discounted by about 8.7% year to date. This is doing well. Over the 1 year, 89%. Man, this stock is killing it. Holy smokes. And it's $3 billion in market cap, and it's gone up 674%. Nicely done, Innova. You have given investors a ride. So these guys are growing 21.5%. Revenue is 1.3 billion. Okay. The trailing 12 months. So they're doing the technology side of things for this industry. The free cash flow 1.5 billion. Is that right? How could it be that high? Yeah, something isn't making sense there because the market cap's 3 billion. Okay. That's a little too high. It's like that doesn't make any sense. Okay. So you know what I'm going to do is I'm going to take a look at their actual financials because that tells me a lot about a company because it kind of breaks out their operation and I'm able to see, are they really a lender or are they a technology company? All right, so earnings, listen. I think this might get me what I'm looking for. Okay, so originations rose 26%, revenue increased. So these guys are more into finance. So this is a finance company, okay? And they're talking about the liquidity. So this is not a technology company. This is a finance company. Nothing wrong with that. It's just a different animal. Okay. Assets. So I'm looking at their income statement and going, okay, you got revenue and then change in fair value, net revenue. Okay. Okay. So if they're a finance company, I don't use free cash flow. I want to look at book value and see how they're growing book value because that's how banks get valued. And you see that these guys have gone from book value per share of $10 per share in 2018, and it's just going up. Very nice. Very good. Okay. So that looks good. And you'd have to analyze the book value. And let's take a look at how many analysts? 7 analysts. Okay, good. That is a pretty decent group of investors. PE, but why are they giving him such a low PE? Yeah, this one's investable. You got to value this one by their book value and value their earnings per share. This one also is going to go on my homework list because I think it looks interesting and it's small. I just feel like, geez, man, this one's just been exploding. Look at that. Incredible. I want to get to know this company. It has good fundamentals. I just want to study their history. What are they about? Do they really have a good, innovative product or list of services? Or are they just run-of-the-mill, financing? If they're run-of-the-mill financing, I'm like less interested. If they're more innovative, I'm more interested. Their stock's just been killing it. So this is a good one. So this one's investable. I'll do some homework on it, and I'll bring it up on maybe the next live stream or the next investor only video. So look for that there. All right, good stuff, man. We're gonna end the live stream on a couple good ones. So that is it for today. Thanks again, Sebastian. You brought a couple good ones tonight. And I'm going to take a look at those two and see what they're all about. See if those are good investments. We'll go from there. So thanks again, everybody, for tuning in. And I think that's going to do it for tonight. Everybody, I'll try to live stream again probably Wednesday in the morning. And we have an investor, paid investor call tomorrow in the morning and then on Wednesday evening. So for all you members out there, if you can join tomorrow, that'd be awesome. And then on Wednesday night, that'd be great. Everybody, thanks for tuning in. We got a lot of people on the stream. I think we covered a lot of interesting businesses and covered a lot of good ground here. Let's see how the market trades. It is expensive. Let's be patient. Let's be wise. Figure out how we can make money on the second half of 2025. The first half's been great, but we got to figure out how to keep it going for the second half. It gets a little harder as you get higher prices in stocks. So everybody have a good night. Thanks again for tuning in. We'll see you guys.